Hello, everyone. I'm David Darst, here to bring you up to date on the securities markets developments in the month of July. Now, we've had a big rally in the month of July since June 16th's low. The low of June 16th for the Standard & Poor's 500 in the U.S. market was 36.66, climbed 12.7% since then. Two major reasons. One, the profit reports for many companies for the second quarter were not as bad as people were fearing, and especially the guidance, the forward guidance. Not everyone. Walmart had difficulty, and the stock sold off 8% right after they announced their quarterly results. But Coca-Cola, McDonald's, General Electric, they had very good things to say about the results as well as the outlook. And so that's point number one. Number two, interest rates have fallen considerably. U.S. Treasury market has had a big downward move in yields since June the 16th. The two-year Treasury has gone from 3.14 to 2.92. That's 22 basis points down. The 10-year has gone from 3.28 to 2.67. That's a 61 basis point decline in yields. And the 30-year has gone from 3.35 to 3.03. So that's 32 basis point decline in yields. The other big news, the Fed basically raised interest rates another 75 basis points, as you know, on July the 27th. And on July 21st, the European Central Bank raised interest rates for the first time in 11 years, and they raised interest rates by 50 basis points. We had the economic report of the second quarter. The second quarter GDP came in. Housing was weak. You had inventories were weak. And had it not been for good export performance, they would have been much lower than it was. It came in at minus 0.9%, 0.9% after minus 1.6% for the first quarter. Why have interest rates dropped like this? Basically, the markets are interpreting the Fed as basically going to continue raising interest rates between now and the end of the year and then begin to take interest rates back down. So this is what we call peak inflation leading to peak hawkishness by the Fed, and that's why the markets have been rallying. And, of course, the better profits. Now, you've had layoffs. You've had reduced hiring. Even the big tech giants, Shopify, Ford, but even Apple and Google have said we're going to slow down our hiring. Lead economic indicators have been down now for 4 months in a row. Apple, Amazon, Microsoft, the big three, all of them came in pretty decent report for the second quarter. Chevron and Exxon, they have announced the highest quarterly profits ever with oil prices where they are. So you've had, as I say, you've had a mixed report by some industries, but by and large, Wall Street has decided to see this as a glass is half full earnings report. Now, on the inflation front, you had at the very end of July, the personal consumption expenditures on a headline basis, it was up 1% for the month, and it was up 6.8% year over year. That's for the month of June now, and that's the largest since back in January of 1982. On a core basis, and now that's stripping out energy and it's stripping out food. On a core basis, it was up 4.8% year over year. And in May, it was up 4.7% year over year. So you have had a continuation of inflationary pressures. The employment cost index, the Fed looks at that. Chairman Jay Powell commented on that in his news conference following the July 26th, 27th meeting. It was up 1.3% for the second quarter and up 5.1% for the last 12 months. The Michigan consumer sentiment, which is another, it's influenced heavily by inflation. It came in at 51.5. The all-time low was 50.0. It's not a good report for that. Now, we're going to be watching very carefully the August 10th Consumer Price Index. That's going to be very, very important. However, the Fed has no meeting in August. The next meeting is September 20th, 21st for the Fed. And basically, you see job growth is beginning to slow, and recessionary signs are beginning to appear. But right now, we think it's more of a slowdown for this year than an actual recession. With that, we continue to advocate. We continue to advocate. Private equity is a very good place to get good returns in a low volatility manner. You have, we used to have this 1/3 growth, 1/3 value, and 1/3 defensive. Right now, we would move that up to 40% growth. Take a little bit out of value and a little bit out of defensive, put it in growth. Good quality companies, not these high revenue, no profit companies, but very, very strong franchise companies in the tech space. With that, we look forward to catching up with you soon and wish you a great end of the month of July and a great start to August.